Hello guys. Welcome to a video. This is about draws on liquidity and how you can use it so you don't get trapped. There's a number of people that were looking for longs just because they thought because we pumped before market open, they thought that okay, then we're definitely gonna look for shorts or some shit. And I'm gonna show you how I look for whether I should buy or sell simply off the 15-minute time frame. Just off the 15-minute time frame. Because the thing about trading is that the simpler you can keep everything together is the easier it is to trade. I'm not saying that you should go out of your way. You shouldn't go out of your way to learn every single thing or try to be better, but keep it simple, stupid. That's how that's how you stay profitable. I've seen people get hella money and be profitable just off two confluences alone. So like the more you can, the less you can confuse your brain, the less you can not confuse the less you can confuse your brain, and the simpler you can keep things and being like, okay, then I didn't get that and I didn't get that, I'm not trading, or I did get that and I did get that, I'm clearly trading. So like, yeah, the simpler you can keep everything is the better. Okay. So I was looking for shorts, and I'm going to tell you why. Okay, I'm going to tell you why. Even before market open, at the back of my head, I was like, we're definitely gonna look for shorts. I'm going to tell you why. Now, understanding draws on liquidity is this. The way I use draws on liquidity, I see people do a bunch of different analysis and shit, but I'm going to tell you how I use it. So you have ERL, which is your external range liquidity. Then you have IRL, which is your internal range liquidity, right? And then you can break that up into two more categories, right? For your ERL, you'll have fucking BSO. BSO stands for buy side liquidity. And for your IRL, damn, yeah, sorry. You have SSO. Okay? Now, SSO stands for buy side liquidity. SSL stands for sell side liquidity. BSO stands for buy side liquidity, which buy side liquidity is internal range, external range liquidity, and sell side liquidity is internal range liquidity. And even if it's not that, that's how I grasp it, and that's how I'm going to teach it to you. Okay. So as you can see, market opens, right? Market opens. We've been selling off for the longest while, grabbing a bunch of internal range liquidity, and then London open, we swept some more, and now we're fine, and we're getting a bullish push. Okay, we swept Asia accumulation, we swept sell side, we swept London high, Asia high, we came up, swept more liquidity, and came up and swept this liquidity up here as well. Now, what does that tell you? Right? If we say that price is going from external range to internal range liquidity, or from buy side to sell side, or from sell side to buy side and internal to external, that means what did we just do? We swept buy side liquidity, we swept external range liquidity. What will price high chance do next? Okay, what will price do next after sweeping high probability, after sweeping buy side liquidity? Go down. That's what price will do next. It'll go down and sweep internal range liquidity and sell side liquidity. Okay, this is why I rather draws on liquidity over anything else, because as a trader, your job isn't to predict where the market is going. You have top-down analysis and you have daily bias, and those are basically making you predict what the market is doing, and that's not your job as a trader. If you think that your job as a trader is to predict, that means you've already failed and you'll never be profitable. Your job as a trader is to react off what the market gives you with discretion and trade accordingly. This allows you to react. You're not predicting. Get that out of your head. Okay? Let's say you're looking for a trade between 9:30 and 10 a.m., right? What did price do before 9:30? That's what you're going to ask yourself. You're going to ask yourself, what did price do before 9:30? What did we sweep, buy side or sell side? We swept buy side. Do we want any more buy side? How do you know whether it's gonna stop sweeping buy side liquidity? Look for PD arrays. Look for rejections or reactions of PD arrays. After it swept buy side liquidity, what made it move down? This bearish FVG. That tells you that it doesn't want any more liquidity. It already got liquidity and it filled orders, and orders were filled at this PD array, and now we're rejecting, and now we're going down. So what will it target next? What's the strongest draw on liquidity? What's the strongest draw on liquidity? That sell side and internal range? London, which it just swept. And since it just swept London lows, what do you look for next? Same thing. If you want to trade New York lunch or New York PM, what do you look for next? Same thing that you look for up here. What did price do before it's time for me to trade? It swept sell side. Has it finished swept sell side? You don't know. And stop trying to predict whether it will or it doesn't. Look for any bullish reaction off a PD array, whether it be the 15-minute, the 1 hour, whatever. Look for a bullish reaction. If you get that bullish reaction, orders are filled, and you get a bullish reaction, you're like, okay then, we've clearly swept liquidity. We're done with sell side. Now we're going to continue up to the buy side liquidity, either on the lower or on the higher time frame. And that's how I manage to catch my trades. That's how I do not trade in the wrong direction, because I'm going to tell you what I tell most people when they start off trading. Every strategy is 80 to 90% win rate. Every single strategy, even the basic, just IFVG, just the IFVG reaction alone, which that doesn't even count as a strategy. Just the basic IFVG reaction alone. Put your limit there and wait. That alone can get you 80 to 90% win rate. But what happened is that people trade in the wrong direction. Their pre-market analysis is wrong. Their analysis in general is wrong. And this allows you to trade in the right direction. Every strategy has a high win rate as long as you're trading in the right direction. How can you fail along if the market is going to high chance move to go for a long position? How can you lose if high chance the market is going to sell? And people still lose, and it's not because of they trade in the wrong direction, but it's also because of risk management. It's also because of risk management and position management, which my next video will be that position management. So if you want to stick around for that, cool. See, we're already getting the bullish reaction. So that's my video on draws on liquidity. You have external range liquidity or buy side liquidity, internal range liquidity or sell side liquidity. Price goes from buy side to sell side. When it sweeps sell side, it goes from sell side to buy side. How do you know when it got enough? Look for strong opposite reactions or rejections off of PD arrays. So if it swaps sell side liquidity and you get a bullish reaction or rejection from a PD array near that liquidity, that means you know that we're looking for buy side either on the lower or high time frame, either on the lower or higher time frames. And how do you know what time frame it's going to target next? Well, we're on the 15-minute right now. If we're actually going bullish right now, right? We don't see any 15-minute draw. The highest draw right now is this, but New York AM is already up, so you can't expect that for the rest of the day it'll try to go for this high. So what do? Common sense. We drop down to the lower time frames. Now we got this high right here that we can target. We got this high that right here we can target. When it inverses this gap, you can target this high. Sure as hell, it's not that much points, but if you're just trading for trading's sake, that's it. See, we got another high right here. That's another draw on liquidity. Okay, I wouldn't recommend you go lower than the 5-minute or 3-minute because the 1 minute is just noise. But that's it right there. You wait for an inverse right here. You can just buy. You can just buy as it inverses it, or you can just wait for a retrace. Then target these draws on liquidity. When it sweeps these draws on liquidity, look for a bearish reaction off this FVG, or you wait for a bearish reaction off this FVG up here. And then when you get your bearish reaction, bam, you target sell side, which is now New York AM low. It's that simple, guys. And daily bias doesn't allow you to do this. Top-down analysis doesn't allow you to do this, because I get what top-down analysis does. If you're on the daily and we're bullish, if you're on the 4-hour and we're bullish, if we're on the 1-hour and we're bullish, why would you look for shorts? But that's stupid, because that's going into the market with a predetermined direction. Okay, we were heavily bullish today on the 15-minute. We broke structure on the 15-minute, bullish. We broke structure on the 30-minute, bullish. We broke structure on the 5-minute, bullish. But we're still bearish. We're still bearisher today. We still end up being bearish at New York AM. And all of you that were using daily bias or top-down analysis would have definitely for sure got stopped out. That's just how it is. It's an outdated concept. And only the people that were originally using it from way back when are going to be profitable, because they have market experience to back it up. It's not really just purely off of it, because they can look on the day, they can look on all time frames and say that we're bullish, but still that experience will tell them, okay, then we can't listen to that anymore. We're clearly bearish. Okay, that's why draws on liquidity is far superior, because it takes into account the algorithm of the candles. I'm not saying that's how the market moves. I'm saying that that's how the candles move. Okay, the candles go from, that's how you get your swing highs and your swing lows. It doesn't just completely go up. It doesn't just completely go down. It goes up, creates a lower high, goes up, creates a higher high, goes down, creates a lower high, goes up. That's how it moves. And this takes advantage of that. So I would recommend rewatch this video, take notes if you have to. Hop on TradingView or FX Replay, backtest, forward test this, and see what I'm telling you. Stop trading in the wrong direction, bro. Yesterday we were bullish, and if you were looking for bulls, you wouldn't have gotten your long position until later on in the day. You wouldn't have gotten it, and even then, that wasn't the true direction of the market. Today we're bullish again, and if you were looking for longs, you would have gotten stopped out, and gotten stopped out 3 fucking times. And because that wasn't the move for the day, we swept a bunch of liquidity up here. Why would we want to go any higher after we rejected off this FVG? Okay, go ahead, practice this. Draws on liquidity, ERL, BSL, IRL, SSL, from BSL to SSL, from SSL to BSL. Get to work.